Welcome to this video. We're going to do a deep dive into cash flow from operations. There's basically two aspects of it, the direct method and the indirect method. The operating cash flow is one of three parts of your cash flow statement: operating, investing, financing. This video is going to go over operating activities. The next video will go over investing and financing activities. Review of the facts. Cash flow statement has operating activities, investing activities, and financing activities. As we recall, the operating activities, these are the things that are the core part of the business. They're the core operations of the business. You are in the business of selling frozen bananas that are dipped in chocolate. That is your operations. Investing activities are anything you do to improve the operations. So say you buy a sign for your banana stand, or you upgrade the stand by adding some light features so people can find you at night. These are kind of investing activities that are supposed to expand over multiple periods. And financing activities are different things that you might do to get money in the business. So you might sell some equity, you might get a loan, you might pay off a loan, or you might buy back equity. The direction of the cash doesn't make a difference. It just is the type of activity that each one of these cash flows represents. And as you recall, we looked at the beginning of this class at Tesla and what caused this crazy spike after 2013. Why did it spike? And as you were initially, if we looked on the financial statement, let's look at the income statement for Tesla first and just do a little bit deeper dive. Tesla, if you looked in 2012, they had this 7.3% margin. What I did, I took their gross profit. This is their consolidated statement of operations. This is the income statement. What I did is I just said, okay, well, what was their margin on their automobile sales? All right. So it was 7.3%, and here it's 22.6. So in 2013, their margins went up huge. Now they're selling a fair amount more, but their margins went up just insane, right? And if you look on the year, they still had a net loss, right? They still had a net loss. The loss is lower, but man, their margins went way up, right? Their margins went incredibly high. The question is, okay, well, what are some aspects of what's driving those margins? This is the income statement. This is the cash flow statement. And you'll notice the cash flow statement has three parts for Tesla. It has cash from operating activities, cash from investing activities, and cash flows from financing activities. What I've done here is I've highlighted this net loss up here. That number looks really familiar, doesn't it? Where have we seen that number before? Well, we saw it on the prior slide right down there. That's million, right? So 74 million is the loss for 2013, 74,014. And if you look, 74,014 in 2012, 396,213, 396,213. That's because our income statement is linked to our cash flow statement. At the top, you will have, under the indirect method, you'll have the net income. The whole point of the indirect method in this statement of cash flows right here is to let us know where cash is going to and from in the business. Initially, it's going to be hard for you to understand this, but it's important for you to remember this link. And the reason why is because what we're doing on our cash flow statement, particularly during the statement of operation cash flow from operating activities, is we're squeezing out and we're cleaning out all the accruals that are inside of that net income. So what we do is we start with net income, and then everything we didn't get cash for, we squeeze out and we back out. And everything we did get cash for and we didn't account for it, we count there too. So if somebody gave us money early for something that they'll get delivered later, we would count that now as getting cash now. All right. And if we pushed off an expense that we didn't pay now, but we marked as an expense now because we technically are going to have to pay it in the future, we wouldn't count that expense now. So what you're doing is you're taking out all of the accruals. You're squeezing out all the accruals so they all come out. And so your net income, you can see what the changes in it and where they are from to get to your operating cash flow. So if we look at this, some typical things that we'd expect are positive cash flows. For example, depreciation, amortization. This is a non-cash charge. When my son took a rock to my car and decided to carve on it. Now, I experienced some impairment of value to my Honda Odyssey, but the reality is it was a non-cash action, right? It was a non-cash event. So if you look here, there's some other things that we would add back. Stock-based compensation, that's not cash. That's not a cash item. It has value, but there's not cash. So if you go down, there's a lot of different things here that get backed out to get these cash flow from operating activities. Net cash provided by used in operating activities. And down here, we see what we got to, that 257 million in positive value, up from 266 million from the year before as a negative cash flow. That's the overview. And if you look at the bottom, cash and cash equivalents at the end of the period right here, that amount, that's what ties to the balance sheet. You'll notice here, cash and cash equivalents of 845 million, it looks like, 845 million for 2013 and 201 million for 2012. Well, look at the bottom here, 845 million and 800 and then 201 million for 2012. So our cash flow statement links our income statement and our balance sheet. And that's why it makes it such, it's a tasty financial statement, because you can link things together. Remember that, because understanding those links, that's what people like to ask questions about, like me, right? We like asking questions. It's always the questions. Do you understand how they're linked together and how these things are going to match up? Okay. That's an important thing. So that's the overview of the full cash flow statement, and how it maps onto the balance sheet and then the income statement. Now, if we look from the cash from operating activities, we can dive in deeper to what happened with Tesla. And if we dive in deeper from these operating activities, I just blew it up and I zoomed it in here. What we see is there's a lot of different items here that we'd expect. And there's a couple of that we see here that are a little weird, right? So deferred revenue, what's that? And then resale value guarantee. Well, there's deferred revenue and resale value guarantee. Tesla has a fair amount of this deferred revenue or unearned revenue. And the resale value guarantee is also a component of this. So deferred revenue is when you collect revenue before delivering a product. I think right now they're doing it with the Tesla truck, where they collected revenue before they actually delivered the product. And then the resale value guarantee was another aspect that they had, where initially when Tesla started, everybody was worried. Tesla is the most successful startup in the last, 20, 30 years in the automobile industry, because as far as companies go, we don't have very many auto car companies that are startups in the United States. It just doesn't happen. And so they were an electric vehicle too, on top of that. And everybody was a little nervous about Tesla surviving when they started. So as a result, they added a resale value guarantee so that people that bought the car knew that they could get value at least out of the car by having a guarantee that the company would repurchase the car at the end of like 5 years or so. And it's detailed in the footnotes back in the day. Now they don't offer the same resale value guarantees to my knowledge. So this deferred revenue and resale value guarantee, they're adding these things back, but really that wouldn't factor into the margin play that we saw before, because it's not included in the margin. Adding those back actually just shows that they are actually getting more cash this period, okay? But the margin, that's the real question. Where are they getting this extra juicy margin from? And we found out from looking at the footnotes that they increased that margin. They actually, it wasn't a bright line thing that they provided, but down at the footnotes, they got about $200 million from their competitors paying them essentially to sell cars because of the zero emissions credits that they had in the state of California, New Jersey, Arizona, and all the other states that adopted these policies. So this is what caused this value gain in 2013 that caused the stock to do this. All of a sudden, they had figured out how to get additional margin from selling cars. And I don't even know if this is factored into the analysis here. It's not just margin, it's margin from competing car companies, which is so cool. So the cash flow statement took us down a path to kind of determining, okay, where are they getting extra cash? But the reality is that most of these other items that we saw on this statement gave us some information about what was going on, but really we had to get down to the footnotes to really figure out what was going from the cash from operations. But look and see what's happening here. See, they start off, this is called the indirect method. They start off with the net loss. They start off with net income. In this case, it's net loss. And they adjust for all these entries. So they have some inventory write-downs. Well, yeah, inventory write-downs are economic loss, but you don't have any cash that goes out the door. So they had to write down, 8.9 million in inventory. Something happened with their inventory that they had to write it down. Write off Department of Energy loan origination costs. So they had a loan that they had to write off here. Change in fair value of Department of Energy warrant liability. So there's all sorts of things in here that are just these non-cash items that because there's not cash involved, they have to get them out of there. They have to take them off. And so that's the whole point. With cash from operations, you start with net income and you're squeezing out all the differences in accruals. It's important to remember too that it's not just accruals that you're getting out. You also have to take out of net income anything that's not an operating activity. So what that means, if you have an asset you sold and you got a gain on it, well, that gain might be an economic gain, but that asset, that's associated with investing activities. All right. If you have like the RV from Walter White that got sold or it was a loss, anything associated with it, gain or loss, has to be taken out because that's an investing activity. And then financing activities. If you have a financing activity that is incorporated in net income, you have to take it out if it's part of financing. So remember, net income, the whole process of the indirect method, we're taking out all the accruals and we're taking out all the investing and financing activities. Anything that is not operating gets out. So that means any purchase, gain, or sale, you're out of here. Things that would be possible financing activities, you want to get out of there. All right. So financing activities, investing activities, and any accruals, that's what we're taking out of operating cash flows. And so that we can get to that distilled amount of what our operating cash flow is. This is another example of Colgate's operating cash flows. All right. So they start off with net income of $2.5 million in net income, non-controlling interests. And then net cash provided operations is kind of close to that. It's 2.8. And you'll notice their net income, even though that they back out depreciation, restructuring, different gains or losses or receivables that they take out, the inventories, all these things that they have to squeeze out of that net income that is not operating cash flow, it still ends up being pretty close in the case of Colgate's net income. They end up being close together, whereas Tesla's, they were way apart. So how does operating cash flow compare with net income over the 3 years? Over the long term, it's a mature company. Operating cash flows should exceed net income. Your operating cash flows over the long term should exceed the net income that you have. If a company has rising net income and falling cash flows, it can be a red flag. If they have rising net income and the cash flows are going down, remember, the beauty of reporting the cash, and the whole reason we have this statement is it's really easy to check the cash. You call the bank account and say what transactions happened, and the bank tells the auditor that. So it's really easy to check cash. The accruals, you can just kind of make it up however you want. That's where the cook in the books comes in. That's where the French chef comes in and cooks the books and makes things happen. It's all with the accruals. The cash is where the rubber hits the road. If a company has a rising net income and a falling cash flow, it can be one of two things. For example, it might be a sign of potential problems, slowing of collection accounts receivable. So a great example of this recently was Under Armour. Under Armour got in trouble with the SEC in part because they had been playing around with their bad debt expense. What happened was they started putting out a lot of their inventory out on account and selling it. And the reality is that they were too aggressive in how they were reporting it. They really had a lot more losses that they should have recognized with the accounts receivable that they had. So a firm that wants to push out the sales more, you can find somebody that will just take your product and say, yeah, I'll pay you later. The reality is their ability to pay matters. That matters for that, and that should be factored in. So a firm could have, they could do the same thing with costs. They could estimate their costs being lower for that given period and do that over time. But the reality is, and to make their net income bigger. The net income gets bigger, but if the cash is decreasing, the cash really is a sign of what's actually going on at kind of like a base gut check level. So it could be a sign of a problem. Alternatively, it could just be a natural thing that occurs in the early years of a business. All right. The idea that you have rising net income and falling cash flows could be a sign that you have growth and that you're reinvesting in new things to kind of build the business. And it's very normal. So it's either a red flag or it's normal. And based on the business that you're looking at. So Tesla is a new business, totally new tech that they're trying to roll out across the United States. Even to this day, it's still kind of seen as new and fresh. Whereas Colgate, they're just making toothpaste. I mean, it's hard to see what would cause a big spike in toothpaste use across America, right? I mean, you basically are brushing your teeth 3 times a day, 2 times a day, 1 time a day. But I mean, the reality is there's not going to be a spike in that, but there is going to be growth in Tesla. And so as a result, rising net income, lower cash flows for Tesla makes a lot of sense. But for Colgate, if you saw that on a dramatic scale, you'd say something's going on here. And I like to equate this like red flag to what it was like when I moved into my first house after my doctoral program. So if you had come over to my house, you would have seen this. It's kind of a fuzzy picture, but this essentially was the inside of my house. You'll notice something missing there. Furniture. I didn't have any furniture inside of it, all right? And that's not normal. It's not like some weird religious thing or something like that. What was going on was I didn't have any money. I didn't have money. I just graduated. We'd lived in a small apartment in Boston when I was in my doctoral program, and we were just waiting to figure out what kind of furniture we want. So the first several months we were in there, it was just kind of like a ghost town because we didn't want to just go and buy a bunch of garbage and just fill it full of garbage. So we waited and we tried to pick stuff out. So somebody come into our house, not knowing our background, would say, oh man, what's going on here? What's going on with the weird Welches? We got an empty house, right? But the reality is that if you knew the background and said, oh, they just finished school, they're still waiting to buy furniture, they came from a small apartment, you'd say, oh yeah, okay, that makes sense. That sometimes happens. Same thing happens with a business with these cash flows. If you are at the early stage of the business, that separation's totally normal. With net income and operating cash flows. If you are in a late stage of a business, if you're really mature in your business and you see something like this, then it's that. Then it'd be kind of like a red flag. All right. So operating cash flows statement format. All right. So there are 2 acceptable formats for reporting your operating cash flows. 2 acceptable, but one is seen the most. Okay. And by the vast majority. Operating cash flow is most often seen based on the indirect method. Indirect method. That's the one that we've gone over where you start off with net income and you squeeze everything out to get to operating cash flow. That's the most common way you're going to see it almost every single time. On occasion, you'll find a firm that does what's called the direct method. And the direct method of cash flows is a little bit simpler in the sense that just tells you how much did you collect from customers, how much did you spend on your operations, and a couple other minor things, and then cash flow from operations. And the reason why you have the difference is that one is direct in that it summarizes things kind of totally, but there's a beauty of the indirect method in the sense that it maps your net income back to your operating cash flows so that you can see where things are going from in the business. And it follows how most analysts view and do their calculations of dealing with net income and backing out certain items. So as a result, most companies use the indirect method. And even when a company does the direct method, they frequently will offer another table doing the indirect method. So you'll find that in this class, we study and we focus a lot on the indirect method, but it's important for you to know what the direct method is. Oh, don't forget, this difference between indirect and direct, it only matters for operating cash flow. Investing cash flow and financing cash flow is done all direct. So that just means it's like cash spent purchasing equipment, cash received from selling old equipment, cash received from issuing bonds, cash used from buying back equity. Like that's the direct method. Investing, financing, it's the same. It's all direct. The only one with this nuance is operating cash flow. And the reason why goes back to kind of like this healthy body thing. We really want to find out if the core of the business is healthy. And so we want the most detail about that. All right. The most detail about that is going to get us to understanding this core value of the business. Oh, I forgot to mention the way you remember this is indirect starts with IN, indirect. So does net income, right? Indirect net income. You'll know it starts with net income if it's the indirect. The IN is the giveaway. All right. So indirect is net income. The direct method just shows you the direct cash flows. Okay. Now, getting back to what we do on the indirect method, we take out all non-cash items, all operating items, and net changes and operating accruals. I'll get to that in detail. Non-cash items might be an inventory impairment like we saw with Tesla. Non-operating items. So if you sold equipment for a gain, that gain would get factored into your net income, but you're going to have to peel that gain out as far as your net income on your income statement. And you're going to have to take out whatever you got from the selling of that equipment, the gain on that. And you're going to actually have to factor in the direct method or just the total cash you received from selling that equipment in your investing activity. So that's a non-operating activity, because selling equipment or buying equipment is not direct, it's connected to your operations, but it's not an operating cash flow. That's an investing cash flow. And so selling the equipment is what would normally show up on your net income. And so you're gonna take that out. You got to check out the net changes in operating accruals. We'll do an example video of how to do this when you construct your own cash flow statement. And then the two arguments for this is the main reason it shows how you get from net income to the operating cash flow. That's important. And then also it mirrors how analysts do their forecasting. The direct method shows specific cash flows as they relate to specific accounts and what just happened entirely in the period. So some of the advantage of the direct method is that it gets to very specific sources of cash flow. How much total was received from customers? How much total was spent on operations? So the direct adds some value because it lets you know about direct sources, but the indirect just gives you a bit more information, and you could back into a lot of the direct numbers based on the indirect method already. Indirect method. The indirect method begins with net income and adjusts to operating cash flow. Arguments for it clearly shows the reasons for the differences between net income and operating cash flows, mirrors the forecasting approach. These are the two reasons why companies do it. Direct method shows each cash flow and outflow related to receipts and disbursements in total. And then arguments for it provides information on specific operation cash receipts and payments. It does not net. And the reality is that we can probably figure it out if we have the indirect method already. And so it's not something that you see that often. Most companies do the indirect method. Colgate's operating cash flows is an example of it. This is an example of the direct method. You'll see that they have, this is Tech Data Corporation, some rando company. Cash flows from operating activities, just it's total cash received from customers, cash paid to vendors, interest paid, income taxes paid, done. Right? It's just boom, 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 done. It's like 4 points. Whereas this has like all the nuance of the accruals and all that other stuff that you take out. And that's part of the value add of reporting it, because we can see how aggressive their accounting's being, all the extra things they're putting in. But this is a company that does the direct method. All right, this is another one. Portugal Telecom, cash collection from clients, suppliers, employees, payments related to net income, post-retirement benefits, that's also employee related, and then payments relating to indirect taxes and other. That's the direct method. So this, you see how this doesn't start with net income, right? This doesn't start with net income. This doesn't start with net income, but this does. So this is the indirect method of doing it. Colgate's operating cash flows. This is the direct method, and yet another direct method. So the way indirect and direct method relates to these two, almost everybody does the indirect method. IFRS permits it, US GAAP permits it, used by the majority of companies, whether reporting under IFRS or US GAAP. The direct method, IFRS encourages, I think, just to be different, but the reality is most don't do that. They usually do the indirect method. US GAAP encourages, but requires a conditional reconciliation of net income to cash flows from operating activities already. So if you're going to report it once, if you're not going to report it on the actual financial statement, you have to report it later in the financial statement someplace else. So you might as well just do it up there. This is where you might have some differences in where these things end up in operating, investing, and financing cash flows. And this is a great place to ask a question to see if you remember. And the best thing to do is to not look at this and kind of like, I've got to memorize. What you want to do is you want to think about a principle that will guide what you want to do. And generally, this principle that you should always take when looking at financial reporting, and the principle that will help you get through the question to get it right, is that IFRS is generally more liberal and more accepting of different types of reporting and methodologies and approaches, while US is not. All right, so US is not, and usually goes with more conservative. And in the case of the cash flow statement, anything that would make your operating cash flow likely look a little bit worse, technically that's probably where they land on conservative approaches. So let's look at interest received. Interest received. So this is interest received on say investments that you've made. A subsidiary's debt that you might have loaned some money to your subsidiary or something like this. And IFRS, you can report as operating or investing. Under US GAAP, it's operating. All right. You made it an investment. The interest is going to be operating. Interest paid is also going to be operating. And under IFRS, it's considered part of financing, the interest that you pay on it. Under US GAAP, it's only operating. Dividends received, operating or investing. So they say you own a part of one of your subsidiaries and you receive dividends from that. Under US GAAP, you're going to count that as part of your operating activities. You're going to treat it like a piece of equipment that gives you money. Dividends paid, operating or financing, and under US GAAP, it is financing. And so it's important to remember this difference. The dividends received versus dividends paid related to US GAAP or IFRS. If it's dividends received, that means you made an investment in a company and you're getting money from it. And the US looks at that and says, well, that's just like buying equipment and it does stuff for you, enabling you to make more money, right? Now, dividends paid is completely different. Part of the reason why you pay dividends is to appease your shareholders for holding your stock. You want them to hold your stock and for the value to go up. And so you pay them dividends to offer part of their return on this. And this is where it differs a little bit from debt. And under the US, interest paid is considered operating, where dividends paid is financing. And where interest appeases your debt holders, dividends also appease your stockholders. But for some reason, the US has decided to make those different in the sense that financing for dividends paid and operating for interest paid. And even though both are to appease the people giving you money, that's something that's different. IFRS just says, you know what, just be consistent and follow the principles, either operating or related to the activities that, the other categories it could be. If you look over this whole thing, most of it is considered operating activities under US GAAP. And if you remember, IFRS is a little bit more flexible. It could be either or. That'll get you a little bit farther as far as answering questions and knowing this for the future. And that difference between interest paid and dividends paid is helpful too. So in summary, the operating cash flow statement consists of basically all the transactions that are most frequent and typical. There's two different ways of reporting your operating cash flow: the direct method, the indirect method. The indirect method is the most common. It starts with net income, IN for net income, and IN for indirect method. IFRS and US GAAP have differences in what they will report and include in operating cash flow. And it's because operating cash flow is the critical nugget that you're trying to figure out in the business to see if it's very, very healthy or if it needs that injection of something else, outside capital or something else to fix the problems. See you in the next video where we'll talk about the investing activities and the financing activities in the cash flow statement.